All right, guys. Good day. How you doing today? All right. Yeah. I want to share this powerful strategy with you that you can use to take trades on any currency pair, synthetic indices, cryptocurrency, and any other asset relating to forex trading. Maybe you try several strategy. There is none that is working. I'm telling you, you can employ this strategy, and if you can spot it on daily basis from higher time frame, you can switch to your lower time frame and take the entry. It works. I'm telling you, it works. There are different strategies you can use to trade in the forex market, and then but you have to find the one that can give you consistent profit, reduce your loss, and then you can stay in the market, because statistics shows that um, only 5% of the trader are profitable. 95% of others are just running into losses on daily basis. Imagine tons of millions of dollars going into losses. So only very few people are amassing this wealth. So I've taken my time to study and backtest this, and it works. So that's what I'm sharing with you. So all right, let's go. So I'm using volatility 50 index, and I'm on the daily time frame with the strategy. I call this strategy the three candle strategy. The three candles strategy. All right, this is how it goes. Now, when you go to your higher time frame, you do this on higher time frame. It works on almost all time frame, but I will encourage you to use the higher time frame so that you can catch a lot of pips, and then you can confidently take the trade. So all right, you go to your higher time frame, you spot the current trend. That's the first thing to do. You have to know the current trend. Looking at this right now, you can see right from here the market was doing higher higher low. Then when you reach a point, the market has given you this kind of high, you carefully watch what is going to happen there. That is where you want to see the movement. When you see market has reached a particular zone and is no longer moving, maybe it broke a particular level, and then you want to go back and take liquidity, you have to take note of that particular zone. So what do you need to do? You have to understand market structure. I've done a video on market structure. It's called Market Structure 101. You can take time and watch and understand market structure. So with that, you'll be able to spot where this particular entry that I'm about to teach you works. Practice this and you'll see it change your trading life. All right, this is on daily time frame. Now, when you see this eye, it shows that this is a resistance. This is a key zone. This is a key zone. Now you need to watch the candles that form after that time. Now this is a bullish candle. This is the last candle that formed. It swept all this liquidity. Take note of that. So what you expect is that you expect the market to go bearish, right? And sell. That's what it simply means. So now if you are using liquidity sweep strategy, you can take this trade. Like one of my strategy principle 1, 2, 3, 4, 5. This is it. Liquidity sweep, break of structure, inducement, and then return back to the other block. You can take this, but this I want to show you in case you don't know that strategy. Now you take note of three candles that follow each other. I mean three bearish candle that follows. Like for example, this is a bearish candle, a bearish candle. You have to pay attention to the third candle. That's where you're going to take your entry. So now look at this. Now you only spot this after there is in between there is a bullish candle. There must be a bullish candle in between the candle you want to use. Means that the last candle should be bullish if you want to take a bearish trend. If you want to take a bullish trend, the last candle should be bearish candle. So now look at this. Now this is a bearish candle, right? So you begin to count from that bearish candle. This one, this candle one, call it candle one. I'm doing it so that you can understand what I'm saying very well. This candle one, see like that. Now you mark it to the end, ensure you box it to the end where the last wick of that candle reached. Let me take out this box so that it doesn't block. Let me use a number. 1. is candle 1. Take note of that. So you look at, then you mark the closing wick. This is the closing and this is the low of that candle. Now this is a bearish candle. For a bearish candle, market open at the top, closes at the bottom. But this is a wick. This is wick. This is where you need to mark. You put your horizontal line here. That's where we're going. Now you wait for the next candle to form. The next candle to form. I see right now, the next candle form. You take note of that. The close of the candle. Now, the third candle that you want to form, you are waiting for that candle to come and touch this zone and you take your sell. If it doesn't come there, that means you don't have a trade. You go to the next candle. You put your wick on the next candle. Put your wick, your horizontal line on the next candle. The next candle coming, you are not taking trade. That's if you open it. Remember, this is a daily time frame, so it takes 2 days for this candle to form. Now, when the market opened the next day, you put your horizontal line. You expect the candle to come and touch. So here now, this is where you take your trade. Now, I will take you to where this particular trade happened. So put our horizontal line here. I'll go to lower time frame. I use 15 minutes as my entry. So go to 15 minutes to go and spot that. So this was on 6th of July 2025. So let's go look for it here and see how it played out. 20 July 2026. Oh, the market couldn't give us. Let's look for 30 minutes. 30 minutes. Let's see, the 30 minutes will give it to us. Okay, 30 minutes gave it to us. So now see our horizontal line where we placed on the 6th of July. You can see right. This is where we play our horizontal line. So you wait for the market to come and touch that your zone. Here, you see, it touched it. This was the second candle. The second candle broke down. Then it came to retest it. As it retested, this is where you put your entry. You enter. Now see the massive sell that happened since that time. The market has been selling and it has not returned to that zone ever since that time. See, powerful strategy. This strategy can give you consistent profit for life. So now, even if you just take this alone, you are in massive profit. Now from this zone to this zone, this gave 789 pips. So if you risk $100, just $100 to take this trade, you would have made almost 8,000. I mean, let's say $7,000 for as long as this trade moves. Yes. Let me do the calculation over here. If you use 100 lot size on, you risk $100. Then let's say you want to use what's it called, 100 lot size on volatility 50. For example, I'm doing the calculation using my phone now, and you want to see how many pips. 789. This is 780. Now it now depends. Let's say you want to risk $100. You are risking $100 and use 100 lot size. As this market gets there, we're going to be having, if you enter just one lot position, we're going to make $789. So if you are a high risk taker, you enter with 3 lot size, you'll be making almost $16. Depends on the level of your risk, but I always advise people that don't risk too much than you are willing to let go. So if you enter from here, you put your stop loss around this zone, or better still, at this recent high. Put your stop loss here, and then you ride it. When you get here, you can take some of your position, leave one to come back for as long. And once the market has moved this way, learn to bring your SL to somewhere around here. So in case if the market come back to this place, you won't lose so much. You get what I'm saying right now? So this go like that. You better use higher time frame. It works on lower time frame. Look at this. First candle. This is the first candle, second candle, and the third candle. The market came right here, and it still went down. It's the same thing happened here. 1, 2, 3. Third candle, the market came down. So you have to take your time to study. Look at this candle. 1, 2, 3. Third candle, the market came down there. It works. It works. This is for bearish. So let me show you the bullish trend. So let's go back to our 24-hour time frame. That's daily time frame. It works on all time frame. So now we just finished up with bearish. So let's look at the bullish trend, because I don't want this video to be too long, so that you can watch and take time to practice it. All right. Let me show you a bullish trend, the one I have seen and worked. Okay, let's look at this. So like I told you, you'll make use of it when you see a bullish candle formed. This the previous day, the next day candle sold down, the market sold down. So begin to count the candle from here. This is the candle 1. Your business is this candle. You mark it. I'll go to 4-hour time frame in case you want to wait, because if you're using higher time or daily time frame, you have to wait for days to have this happened. So I'm just using this in case if you are watching it for the third day, you should expect that the market will come there and you ride up for that day. So look at this now. First candle, the second candle, and then the third candle tap into this. So see the masses. So for the next day, for the next 3 days, the market was selling, one was buying. So look at it. So in case you cannot wait for days for this to happen, let's see it on 4-hour time frame. It worked on also 4-hour time frame. You know what 4-hour time frame means? The 4-hour candle. Look at this. Identify the bullish candle, the first candle, the second candle. You mark the wick of the first candle, and then that's where you take your entry. Remember, put your stop loss above here or somewhere around this zone. I won't advise you put it on the wick of the second candle. Put it on the wick of the first candle. So from here now, you enter the trade. That's for bullish trend. Then for the bearish trend. Now for the bullish trend, here you put your candle, you put your wick here. Put it here. The first candle, 1, second candle, it came in. And let me tell you, the mystery around this is called liquidity sweep. The reason why this candle comes back to sweep all this, that it came to sweep all the early buyers. You know, made this candle form, many people entered from here. They entered for that particular hour. But this third candle is to sweep it. So the third candle is to sweep liquidity for its direction. Take out early buyers and take out early sellers. Take out early buyers or sellers. So that's why if you want to apply this strategy, don't rush. Wait for the third candle, the opening. Once you mark that wick of the candle, wait for the market to, if it does not touch it, leave it. If you want to go in before it is at your own risk, but if you want to have sniper entry and with low risk, you allow it to come to that candle, then you can ride it for as long as you want. I want to show you the recent candle that happened today. Today is what? September 1st of September 1st 2025. Now look at this. This was 31st, that was around 16 o'clock, 4 o'clock Nigerian time. This 31st, 8 p.m. Nigerian time, and another day, which is 1st of September. So this happened at the midnight. So now, remember, the last candle must be a bearish candle. You put your wick, your horizontal line right there. Let me zoom this out so that you can see. This is a recent price action. This can change your trading career. See, the second candle formed 4-hour time frame, and the third candle came and tapped into it. Now let's go look for it on the lower time frame. Put my horizontal line on this one. Now let's go to 15-minute time frame, which I usually use for my entry. I use 15 minutes or 5 minutes for my entry. Let's go. Boom. Fantastic. Guys, can you see? So it came in there around 15 seconds, then 30 seconds, immediately the market opened for the new day. What happened? The market started buying and it bought up to this zone. Now from this zone, now from here where your horizontal line is to this place, you've got 414 pips. So if you risk $10, you would have made about let's say $41 if you use one lot size. As if you're using 10 lot size and you want to risk $10. So if you want to risk $100, your risk will be determined by the amount you are willing to lose. So if you want to use $10, for example, and you want to enter 5 positions, so you can just use 5 lot size and enter 5 positions. Remember, it's at your risk. Your stop loss should be right here. This is where your stop loss, the recent low, put your stop loss there. Don't risk too much. So from here now to here should be about 30 pips or thereabouts. 50 pips. So if you want to use 50 pips to get 400, and that's whooping number. So with these guys, you can enjoy the ride. So I'll call it a stop there. If you want to join our mentorship where I teach people SMC and the principle 1, 2, 3, 4, 5, you can send me a DM using the link in the bio on my Telegram channel. I will show you how you can be profitable using the strategy that I have taken my time to backtest and is working. So you can send me a DM and we will take it up from there. But take your time to study this video and backtest it. It's gonna work for you. All right, see you on the next video. Keep winning and keep making profits. All right, bye guys.